between one of the 10 worst days and one of the 10 best was 7 days. 7. The market's greatest single-day rallies aren't scattered across calm afternoons. They're packed into exactly the fortnight when your hands are shaking. To catch one, you have to buy on the day the news is worst, which is the day every instinct you own is screaming the opposite. Lloyd sold on March 30th. The bottom was March 30th. He didn't miss the bottom by a little, he personally attended it. And before you comfort yourself that professionals are immune, in 2007 Warren Buffett bet $1 million that a plain index fund would beat a basket of hedge funds over 10 years. The index fund returned about 126%, the hedge funds returned about 36%. But sit with the twist inside that, because it's this whole video in miniature. Those hedge funds won 2008, they fell about 24% while the market fell 37%. They did their job perfectly in the exact year everyone feared, and then spent 9 years giving it all back. So understand what you're buying when you buy protection. It is never free, you pay for it in every year that isn't a crash. And there are a great many more of those than there are crashes. So if they're not forecasting and they're not buying protection, what on earth was happening in a 4-minute phone call that ended with nobody doing anything? Nobody made a decision that morning. They executed decisions that had already been made, which is the one thing in this entire video you can copy for free today before you finish your coffee. That's the whole thing. Wealthy portfolios don't have a better crystal ball, they have a written instruction set, and a downturn is just the event that triggers it. So let's build yours. 4 items. 3 of them you can do this week, and I'll be honest with you about the 4th. Item 1. Rebalance on written bands, not on feelings. You decide in advance that if your stocks drift more than 5 percentage points from your target, you sell what's up and buy what's down. Automatically, no meeting, no opinion, no cold brew. And I know that sounds like nothing, so watch what it did for people exactly like you. When Vanguard studied over 5 million households through the March 2020 crash, 83% of ordinary self-directed investors made no trades at all. 9% actively rebalanced into the decline, which means the story about panicking retail investors is mostly fiction. And here's the detail that should irritate you. In this past March's drawdown, buyers outnumbered sellers roughly 4-1 on the heaviest days, and the sellers skewed older and wealthier. Median age of the sellers, 56. Median age of the buyers, 40. The people supposedly too naive to know better mostly held. Nadia held. Lloyd, who reads 3 newsletters and could explain the yield curve to you at a party, did not. Item 2. Harvest your losses, because a downturn is inventory. Vanguard estimated that $1 million index position would have thrown off about $385,000 in harvestable losses over a decade. That's worth roughly 0.85% a year to you in a top tax bracket. And nothing leaves the market. You sell the loser, buy something similar but not identical, bank the loss on paper, and carry it forward forever. 2 rules you need. You can only deduct $3,000 of losses against ordinary income each year, though the rest carries forward indefinitely. And the wash sale rule means you can't rebuy a substantially identical security within 30 days, which is the real reason wealthy people own hundreds of individual stocks instead of one clean fund. It isn't sophistication, it's that owning 300 things gives you 300 ways to sell one and buy its cousin. Lloyd, by selling everything in a taxable panic, did the exact opposite. He realized gains he didn't want and locked in a loss he can't use, which is a genuinely impressive way to lose twice in one transaction. And the honest limit, because this decays. Once your cost basis drifts up, the annual value drops to around 9 basis points, which is a rounding error. Loss harvesting is a gift a downturn hands you, and it's biggest the first time. Item 3. Convert when prices are down. Moving your money from a traditional retirement account to a Roth costs you less when values are down, because your tax bill gets calculated on the smaller number while your entire recovery lands somewhere it will never be taxed again. For 2026, you can put $24,500 into a 401k and $7,500 into an IRA. One change catches people this year. If you earned more than $150,000 from your employer last year, Your catch-up contributions now have to be Roth, not optional. Nadia converted a slice in April. It was not dramatic. She did it on a laptop, on a couch, in about 9 minutes. Item 4 is the one you probably can't use, and I'd rather show you than pretend it isn't there. When valuations are down, wealthy families move assets out of their estates at the bottom, using trusts and family loans, so the entire recovery happens in someone else's name. The estate and gift exemption now sits at $15 million per person and $30 million per couple.